So Eric, let's talk a little bit about like where do we really want to invest now and how aggressive do we want to be? There are still a lot of unknowns, but I think that for me personally, and we do pre-tape this, I'm feeling really quite bullish on the U.S. economy. It was interesting though that we saw Expedia's results this morning, and travel is dramatically down. And next week we are going to get the results from a number of retail companies, so we'll get another good read on the consumer. We had Canadian jobs report this morning, and the private sector was down, I think, around 26,000. But of course, they're hiring government workers, so that's not productivity. So, long-winded way of saying, how aggressive do you want to be? How are you approaching the market today?
You bet. You outline very reasonable worries that I think people should have, and you have to be aware of. If these tariffs remain in place at the levels that they are currently at, it is going to be a major headwind for the global economy, for the US economy, likely even for Canada. And so that has a direct read through on the demand, largely for oil. For natural gas is largely immunized. The industrial demand for gas is not as relevant as whether now the build out of LNG as well. So we are a little immune from those economic worries in natural gas, but a stock is a stock is a stock. And so if the broader market sells off, if energy sells off, it's likely that everything would sell off. What we are trying to do is establish, okay, fear, false evidence that appears real. So are we seeing the data in real time? And we aren't so far. When we look at product demand for gasoline, it remains up year over year in the United States and globally. When we look at leading indicators like a crack spreads, that's how much refining margin the refineries have. Well, that falls at times of weak demand. In fact, they've been increasing pretty dramatically, actually. When we look at, we've got access to different platforms that we pay a lot of money for valuable information. We can track demand in real time. In April was up about 1 to 1.1 million barrels per day year over year. So a lot of the very valid worries that people have about a slowdown in the economy, we're not seeing it yet. I don't think people are spending enough time on the supply side. Everyone's just focused on demand. Supply, when we look at the slowdown in US shale, we think we'll lose anywhere from 500,000 to as much as 1 million barrels per day on a December 25 over December 2024 perspective, depending on the price. We would need a lower oil price like 50 to see the 1 million barrel collapse. Well, that would reflect a 1% slowdown in global GDP. So the impact on supply can actually exceed the demand impact that we would have on oil, and at a time when global inventories are remain very, very low. So there's a lot of cushion in that. So as an energy investor, I think it's valid. This isn't like full on beta, full on like super, small cap, super high, upside types of names.
Right.
But I'm really intrigued at the dividend side of things. You can get paid in a large cap 6%, in some smaller caps or mid caps, 9.5%. There's a royalty company in Canada with a strong balance sheet with a 10% or like 9.8% dividend sustainable down to $50 oil. So suppressed, depressed sentiment creates massive opportunities if you know where to look. I'm biased and I would say, well, there's a lot of value to hire somebody to do that for you. But we're finding opportunities in natural gas. We trade in the high threes. We think we need almost 5 to get a meaningful supply response before the market is balanced. And so we can look in the United States, we can look in Canada, names that even in Canada, you can get pretty attractive dividend yields. There's that one company, a holding, it's a mid-cap name, we're getting paid about a 7.6 to 7.7% dividend, and they're growing their production and they happen to be hedged. So they get upside participation, but they're protected on the downside. In oil, we can buy companies with 50 years of stay-flat inventory with no debt. They have net cash on the balance sheet. And even at the depressed price of $60 oil, they can still buy back 6 to 8% of their stock this year. And we get optionality to better days ahead. So this isn't a time to be like ultra bullish, but you don't want to buy into the fear because as negative as people are, that can change with a single tweet. So it's a very unique time in history, I think, that investors and energy investors are dealing with. We made our brand, I think, in 2020 for seeing opportunity when everybody else was panicking. So we try to be pragmatic, see the world as it is, not worse, not better. So I find it very hard to not be excited by the opportunities available to us today, and especially with what we believe is happening, and that is the world has lost the biggest source of marginal supply for oil, and that is a massively bullish development that is just going to take, let's say, a couple quarters to become more consensus, and that should really help to shift sentiment to the positive.
Mhm, mhm. Yeah, I certainly have been picking up those dividend players for sure. I'm just hoping that the balance sheets are strong, but it sounds like they are.
Yeah.
Yes? Okay. Eric, great to be with you. Thank you very, very much.
My pleasure.